Perfect place to start with our next guests here at Post 9. Evercore ISI's Julian Emanuel and Barclays chief U.S. economist Mark Giannone joining us as well, guys. Thanks for the time. Julian, I wonder how you're thinking about the Fed relative to geopolitics, D.C., consumer, deficit spending, and all of those other concerns.
So that last report by Steve Leeson is a sigh of relief. The fact that investors don't have to worry about the Fed is a very good thing, because there's enough to worry about out there. And in fact, we don't think that there is another hike left in the cycle. We do think the next move will be a cut. And frankly, the history of the stock market is such that that tends to be very good on balance. However, the fact that before Steve's segment, we had war reporting from a battlefront shows you that the world is a little bit different this time. And at 19 times earnings, we're very respectful of seasonals. They tend to work very often, but this may be a year where the consumer's confident, which is holding in impressively so, given all of this geopolitics. But there are starting to see some subtle cracks.
So don't add exposure to stocks. Is that your bottom line right now?
That's our bottom line. And again, it's uncomfortable because, look, we loved the market last October at the lows. It tends to work every October. November and December, very strong seasonals, but we just think the narrative is different this time, and the valuations, we don't normally focus on that, but with yields where they are and geopolitics where it is, it's just not an attractive time to add.
Mark, your view on this?
All right. I mean, I think we agree as well that obviously that there's going to be no rate increase this week, but we are a little more concerned about the acceleration in economic data that we've seen in the last few months. In fact, with GDP growth, close to 5% in the third quarter, consumption still accelerating again in September, inflation showing some firming. The labor market showing some reacceleration in payroll employment. All of that, in our view, will force the Fed to need to raise a little more. So we don't think the Fed is quite done that. It's not going to raise rates this week, we think, but in December, I think the chances of another rate hike are quite elevated, we think.
But the rates have moved up a lot already. I mean, the market has done a lot of that for the Fed, which is what I think has changed the most. Yes, we're having hot data, but they seem pretty attuned to the fact that we've seen this big jump in long-term rates.
Absolutely, absolutely. With the 45 basis point increase in the 10-year yield since the September meeting, clearly financial conditions have tightened to some extent. But then the question is it really reflecting just a tightening in financial condition, or is it reflecting the underlying strength of the economy? And we think that a big part of that is reflecting the underlying strength of the economy. And it's therefore not so clear that the Fed has to do a lot of offset here in terms of the funds rate. They were already planning on hiking 25 basis points at the September meeting. And, given the strength in the data, they should have probably increased rates a little more than this 25 basis point hike that they were planning for. And then the question is, how much does the 10-year yield increase offset that?